Hi, I'm Velosovy Knox and welcome to my YouTube channel. What I'd like to talk about today is my new video, and that's about why I'm predicting stability in the markets until August. During this video I'm going to go through my thoughts around what these are and take you through the rationale behind this thinking. Before we go any further, I just want to say that this doesn't constitute any form of financial advice and it's just my opinion, but I'm interested to hear your comments and finding out what you think. Also, remember to like and subscribe to the video below. I should declare an interest that I'm currently long in the market. I hold a number of investment funds and UK equities. So, in my video, I'm predicting stability until August, and there's three basic parts to my theory. The first is that this is not a bull trap or a dead cat bounce due to fundamentals. The second is that the market is currently finding a stable equilibrium based on the current instance of COVID-19. And the third part is that the second pandemic wave is coming and that will destabilise the current equilibrium. Okay, so let's start with an overview of what a dead cat bounce or a bull trap is. So this is the S&P 500 and it's when initially there's a crash, then there's a rally before having a full retracement and further lows. So if you'd like to know more details, let me know and I'll put that in another video. So, what's the rationale behind thinking that there could be a further crash? Well, there's a lot of theory to support this. Here are the charts for the S&P 500 for the last 4 major recessions. Looking at these supports the bull trap theory. During the dot-com bubble and the banking crisis, we saw 50% retracements before further downsides. Also, there was many so-called bull traps during the 1990s recession. During the 87 crash, this was more of an exception. There was a double bottom before recovery. So what can we expect now? What I want to show you is the events that define these timelines so we can look in a bit more detail about what was going on. So this is the graph for the 2007-2009 banking crisis. And what I've done is to add on some of the key events around here. So what we start off with is that in the summer of 2007, there's a subprime mortgage crisis going on and issues with liquidity start to emerge. This is when the Federal Reserve starts to cut interest rates in order to provide liquidity into the market. However, the market does continue to decline and we do see some upside. This is a 50% upside before further decline. And that's where we start to see these market failures and further interventions from the Fed. In September 2008, we see a whole range of different failures coming through, and this is when there is some government intervention, but not enough, and we see this big, massive crash. And it's not until around October time that further government interventions reduce the crash, and eventually it bottoms out towards the start of 2009 before we see the recovery. So the key message here is that there's a series of big interventions and big failures which drive in some of the swings here that we see in the stock market crash. So if we move on to the 2000 dot-com bubble, which again was started off by, we had just this massive bull market and then started off with a few government interventions looking to cool down the markets. There was a recession in Japan as well, but they didn't slow down the market. Right at the peak, we come to the point where Microsoft was found guilty of monopolization, and I think that changed the sentiment in the market, and then we had a series of failures in companies which really did burst the bubble. Then the market carried on going down. We did get a 50% retracement at some point, but then we had the September 11th attacks where the market crashed. There was a recovery before we had a further series of drops. These coincided with some scandals associated with US companies before eventually bottoming out before the recovery. So again, there's not a lot of government intervention in terms of this graph, but there was you could argue that there's two key dynamics here. There's the dot-com bubble which burst, and then there was the scandals which followed, which led to these progressive falls in the market. Okay, so what does this mean? So we can see that bull traps in bear markets, they might be driven by events, and there's also government interventions play an important role. So how does that relate to what's happening now? Well, if we go back to the S&P chart, what we can see is there has been a series of interventions. So the first was after a couple of weeks when the central bank started changing monetary policy to try and support the markets. After that, there was further fiscal support, which again slowed down the decline. And then eventually they seemed to hit rock bottom before we bounced back. And then we had the US stimulus package for $2 trillion. And then after that, we saw a bit of a jump. But I think there's something else has happened, and I think there's something a bit more fundamental. And I think over the last week, what we've seen is actually the end is in sight. So, so the end is in sight, which is a very important milestone in terms of where we are. I think what we've seen is that the epidemics are now being controlled in the major economic centres, and restrictions are being relaxed, which means that we can look forward to returning back to normality. There's also quite a few developments in terms of treatments and vaccines. Healthcare capacity is being expanded so that we can treat more people, and also there's political support for the interventions. So there's a lot of people are very willing to do as they're told. What this means is that for the first time, we can look at the size of the first wave of the pandemic. It means that the economic impact can be assessed, and it also means that we start looking at equities and how they're being valued. So a key question is, how much are equities worth? So given what we've seen in terms of the support from the government and that the end is in sight, how can we use that to help us value equities? So I put this graph up. One of the things about this graph is that it's a decrease, it's a damped sine wave pulse. And the reason I put it up is because this is kind of what I think happens when we see stock market fluctuations. And normally this is, so what you get is decreasing waves and oscillations as people move between essentially the bear and the bull markets. The reason why I'm showing this is normally that there's so much noise going on, these things don't last for very long. But I think with the coronavirus, there's been such a massive shock to the system that we will see this type of wave persist for a bit longer. So in terms of how we can value stocks, this is very, very sort of rough estimates. But the way that I was thinking about it was that you're probably going to get about a 25% annual revenue decrease this year. If you think that stocks are going to take 2 to 3 years to recover. So a stock at around 65 to 85% of its prior value, if it takes 2 to 3 years to recover, then you might get 10 to 15% annual growth. So it's pretty good return on investment. I think that's one of the things that's going to be supporting the stock market in the short term. I realise there's quite a lot in this graph, so please leave a comment if you want me to go into this in a bit more detail. So where does that put us with when it comes to the stock market? So I think we're looking from the previous peaks around 65 to 85% of the total. So a huge range, but I think we're going to stick in there somewhere for the next few months. I don't think we're going to go further down. I think there's too much support from government interventions. I don't think we're going to go any higher because we're still going to go into a recession. So I think we're going to stick in this range somewhere until August time. Okay, so that's my video. I hope you enjoyed watching it and you found it thought-provoking, and plenty of questions in there for me as well. So I'm going to be looking at what happens after August, and in particular what happens if we get a second wave, which I think we will do, of that epidemic. And don't forget to like and subscribe, and hope to hear your comment soon.